This is InvestTalk, independent thinking, shared success.
Hello, this is David. I'm calling regarding Lululemon, LULU. I've owned it for a few months now. I'm up a little bit. Want to get your thoughts on it. If it's a good stock to hold on to or buy more or sell. Looking forward to your thoughts. Thank you.
All right, looking at Lululemon, and this is the name we actually kind of missed this one. We were looking at it back around 260 or so, and then just didn't get in. Now it's up to 372. It is consolidating up here nicely around the $400 mark, and that is overall positive. Now it's not quite as cheap as it was just a handful of months ago, but it's still a great business with very good profitability, and the business looks to be rebounding a bit. Earnings for this year are expected to be up 12% after being up 27% last year, 29% the year before. All-time high in earnings expectations for this year. But obviously that growth is slowing. When you have mid to high 20% earnings growth for a couple of straight years, then you get on a 12. Well, the market's going to re-rate you lower from a multiple perspective. Right now, if you're looking based on forward-looking earnings of $14, you're talking about a high 20s multiple, right? So that is higher than the market, and you're paying a premium for that. But I'm okay with that. I'm okay with a premium because it has a good balance sheet. If you go and look at the profit, the long-term debt is zero, free cash flow 1.6 billion. Now that is down from its recent high of 1.7 billion. So modest decline there. But overall, if you're looking at an enterprise value of 44 billion, what's that? About a 4% free cash flow yield. That's not bad for return equity around 43%. So very profitable. So we like what you're looking at, but I would be a bit more patient on a pullback. I would like it to fill that gap and get down to around the 340 level. That's an area I would pick up Lulu at 340. Currently trading at 372 and change. Now, I've been telling your friends and family that our podcast is available in video form over on our YouTube channel. And we get questions submitted over there. So let's tackle one of those questions now. Sue Connor 5333 says, can you explain how ETFs like JEPQ and JEPI work and how they differ from regular ETFs like Vanguard VOO or VIG? Do you recommend one or both, and why? Does this kind of call option ETF represent any special form problems or reporting at tax time, or any difficulties if they are held in IRA or 401k? If so, thanks so much. During rotation, away from growth, will these underperform? Okay, great question. So the first difference, on the tax side, no, I don't believe there are any major tax differences for these. You'll pay a dividend, you'll pay the distribution tax on the distribution, but it's not anything special like owning a master limited partnership in a 401k or an IRA. Okay, so there's no issue on that front. But if you're looking at the underlying assets, JEPQ follows the NASDAQ. So this is the JP Morgan NASDAQ Equity Premium Income ETF. And so it's a covered call ETF on the NASDAQ. NASDAQ, I believe it's the 100. Yeah, 91 equity holdings. So called the NASDAQ 100. And they're selling call options to bring an income into the portfolio and potentially hedge on the downside. Now, we run a cover call strategy for our clients called Equity Income Plus, and it's more active, whereas JEPQ is just following the NASDAQ, okay? So what it does is it's lower risk than the NASDAQ, just owning the Qs, and that can be a good thing or a bad thing. And like last year when the NASDAQ was up a lot, this is going to underperform the NASDAQ. If the NASDAQ is kind of so-so to down, well, this is going to outperform the NASDAQ. So you just have to understand the level of risk that you're taking. It's just different, okay? Now, JEPI is the JP Morgan Equity Premium Income ETF, and this is not following a particular index. This is more of an actively managed approach, okay? And this is kind of similar in the fact that what's what we do for clients, right? In our Equity Income Plus, we are actively managing, finding the best companies within the universe, Russell 3000 typically, and we're focusing on companies that pay dividends as well as getting that option premium income the similar way to these ETFs are doing. But it's all about the underlying assets that you're holding, because that's what's most important. If they're doing well, you're going to do well. If the market or that particular subset or portfolio that's underlying, that remember, when you're selling a covered call, you're buying the underlying and then you're selling a call option on it. So if the underlying goes down 50%, that call option premium doesn't really matter. Okay. And so you want to be in companies and portfolios that aren't going to have dramatic drawdowns. That's the issue with the NASDAQ, right? NASDAQ was down 33% in 2022. And, these type of ETFs still were down a lot. Let me see if JEPQ was down in 2022 or it was in existence in 2022. Yeah, it was. Okay. So this is a good example. The NASDAQ was down 33%. Okay. This was down, I'm sorry. JEPQ. I was looking at JEPI. There we go. Oh yeah. So this wasn't around in 2022. It started in 2023. So it's hard to know exactly how this would have performed. But understand that they're just different. These are different types of vehicles. Buying the VU or SPY, just owning the S&P 500 outright, exposes you to a lot more volatility than a covered call ETF. It's just lower risk, different types of risk that you are taking, and you have to understand that. Okay.
We hope you enjoyed this video.
Please consider liking and subscribing so you can stay updated with our latest content.
Hello, Justin. Good evening. Thank you for your time and picking up my call. Really appreciated all the knowledge. And this is the first stock that 6 years ago I picked up, just to let you know. And it is 51% of my portfolio, including the growth.
Did you say 51, 5-1?
5-1. This is after 300% increase in the profit. So Thank you for that. But I have a Roth IRA account, and with the recent down in the price, do you think instead of buying any other stock, this is still a good company to add without worrying about my growth in the current tax account? Do you think I should keep on adding in the Roth IRA account Apple at this price with the recent pullback from 260 to now 220?
Well, the simple answer here is no, it's not a good time for you to do that at all, because you have 51% of your portfolio in Apple. Now, is that your total investable assets? How much of your total investable assets are in Apple? Is it still 51%?
Yes, after growth. I originally invested only 5% or 6%
I understand that, but this is what I'm talking about. I'm just talking about, rebalancing your portfolio. And, while we like Apple, we own Apple for our clients. And but there's something that's called risk analysis. Okay. And you have way too much exposure to Apple in your portfolio. It's a great company. There's nothing wrong with it. And, if you want to own 5-10% of your total assets in Apple, I think that's not necessarily the worst idea in the world. But 50%, no. And especially in the tech world, while Apple we think is one of the best of the Mag 7 names from a business perspective, I am not predicting that Apple is going to have major troubles in the near future. But anything could happen. Just look what Apple did to BlackBerry. BlackBerry was a stock market darling, and over a short period of time, Apple announced a competitor, and suddenly BlackBerry's price fell 80-90%. Could that happen to Apple? Sure, it could. Is it likely? No. But, you don't want your portfolio exposed to that level of risk, because and that's the issue here. And so would I trim it today? It's kind of into support. Could it go down to, from 220 now to 200? I think that's certainly possible. So there's still kind of some potential downside in the near term, but that shows you how tied you are to the performance of Apple. So new money, new investments should not be invested in Apple. You should find other investments out there to diversify your portfolio a bit more. And when Apple turns around and rallies, you want to be selling into those rallies and starting to diversify your portfolio. So thanks for the call, but make sure that you're not just focused on the individual companies. It's about portfolio construction as well. And you do not want 51% of your portfolio in Apple. Thanks for the call, Sid. Now let's take another live call, and this is Arias from San Diego, and he's asking about cryptocurrency.
Yeah, how you doing, Justin?
Good.
I must say that I didn't know that Steve had passed away.
Mm-hmm.
May he rest in peace.
Appreciate that.
I remember talking to him many times. As a matter of fact, I remember when Steve first came on the air.
Mm-hmm.
I started listening to InvestTalk back in the 90s when Jerry was on the radio.
I love that. I love that you're still listening. That's great.
Yeah. Well, I lost contact with you guys. I do remember when Steve came on and Jerry told a whole story about how he was a client. And then I liked the way he added a lot to the show.
Definitely.
Basically. So he's definitely going to be missed. My question about cryptocurrency is this. I'm not invested in it at all. But I know that, Warren Buffett never cared that much for crypto. Charlie Munger, Jack Bogle even never cared that much for cryptocurrency. But what was Steve's, how did he view cryptocurrency? I never heard him.
He was not a big fan of it. He was not a big fan of it really either. Now, part of that is anchoring into value investing and things that you can feel and hold and touch versus this kind of nebulous thought of what cryptocurrency could ultimately be, what Bitcoin could be. Now, I understand the ethos of it and where it comes from, and the decentralized potential nature of cryptocurrency. But I think those within the industry probably underappreciate the risks, and those that are critics, they underappreciate what the industry is trying to do and what it's, in many respects has done so far. But I think that the reality is somewhere in the middle. Okay. Trump will obviously be good for adoption of the industry, but it also could create more problems than it solves. Just look at the recent, meme coins. I think the Trump coin, I just read this right before the show, fell 30% in a matter of seconds because Trump said that he doesn't know anything about the Trump coin, right? Basically, he doesn't know. It's not really him. And so, he hasn't really commented about it. And so nobody really knew. And so, it's not really him that's, at least from the basic understanding is that he's not really involved much. And so you see the risk there instantly down 30%. And, you have, I think it was the Reverend that did the prayer at the inauguration. He had a meme coin, then the Melania coin, all of these things that, really are just not good for the industry and makes the industry less credible overall. And that's, I think, the worry is that regulation will become so light touch that it allows the pump and dumpers and the scammers to run amok and make a mockery of what the true crypto enthusiasts are trying to build. And I think that's a big worry for the next 4 years. Another side worry is more cyclical. Crypto in general is a proxy for liquidity. And we think that, based on which I'll talk about in a little bit, that the cycle of liquidity is likely to become a lot more challenging in the back half of this year into next year, which could mean, cryptocurrency likely peaks sometime in the first half of this year. That's probably what happens. Okay. And so,
well, I would say this.
Good.
I would say this. I know, I read about crypto. I don't think I would put my money in it because I don't understand it as much, even though I'm learning more about it. But as far as Donald Trump, he was totally against it in his first term. So when now that he's against it, I have to, you have to take it with a grain of salt. You know what I'm saying? Because it's popular now. It's popular. So he's thinking about is creating wealth.
Yeah.
So I don't really follow what the president is saying. Just people who understand it, I listen to them.
Yeah.
But I think for me, it's just the bread and butter stocks companies that I can understand and let crypto just, become what it's going to become.
Yeah, and what we've been doing at KPP is actually finding companies that are going to benefit from the growth in the industry, because which is trading and assets moving into that industry. And so you're not betting on one particular coin or whatever. It's just saying there's more interest, there's more money flowing there, et cetera, and companies that make transaction fees, et cetera. And that's, I think, a better way to invest in crypto than trying to guess, right, which is the next coin that's going to pop or whatever. Now, you could do that if you want to get deep in the woods and take that risk, but it is a very, very challenging and dangerous game to play. But it's right for some, but wrong for most. Let's just say that. But thanks for the call. Thanks you for the kind words about my grandfather as well as Steve. And yeah, cryptocurrency will have an interesting 4 years, and I think especially over the next 12 months or so. Now let's pivot over and talk a bit about the unfortunate fires out here in LA. And tens of thousands of people, or homes at least, were burnt down. And the big question for the average person is, what happens if that happens to me? Not only from, am I covered, but what happens to my mortgage, right? Because for most people, they still have a mortgage on their home, and they are going to have costs to rebuild and to adjust their lives and to deal with this horrible event that upended the lives of so many. Now, the first thing you can do is ask for forbearance, and mortgage companies are required to offer it on roughly 40% of loans backed by Fannie and Freddie Mac. And then you have loans backed by the FHA as well as the Department of Veteran Affairs have similar guidance. And so odds are good that you're going to have the option for forbearance, usually in 3 to 6 month increments. But loans that don't have federal backing, and there'll be a lot of these homes in Pacific Palisades where the mortgages are multi-million dollars, they also could be eligible for forbearance. Bank of America as well as JP Morgan said that they would offer disaster forbearance for the LA victims of the LA wildfires. And so you have to contact your servicer, whoever you're paying your mortgage to. This will mean late fees, penalties, and foreclosures are suspended on those mortgages when you get forbearance. Now, residents whose homes were damaged or destroyed may be eligible also for property tax relief. And that's coming from the LA County's Assessor's Office. So depends on the local authorities, but you may qualify for some tax relief so you don't have to pay property taxes as well as you rebuild. Now, after the forbearance, you typically have to make up those payments. It's not like those payments go away. Usually tacked on to the end of the loan. That's common. And sometimes it's a negotiation with the borrower and the mortgage company. So you have to figure that out as well. Now, a 2023 paper looked at, this is by the Federal Reserve of Philadelphia and San Francisco. They found that more borrowers fell behind on mortgage payments for damaged properties in the first few months after the fire, which isn't really a shock. Now, the good thing here in California is that you have a non-recourse mortgage, meaning that those that maybe eventually fall into foreclosure after forbearance, maybe they don't want to rebuild their home. They want to move. And maybe now the value of that property or the land is not as much as the loan. Well, they can basically, there's no more keys left, right? Unfortunately, but they can just say to the borrower, I'm foreclosing, I'm giving up my property, and then the borrower can only take back that property. There's no recourse to any other assets. That's, I think, the positive here. A small positive is that those homeowners, first off, there's not much for them to get back, right? Maybe they're going to have retirement assets, money in the bank, but for a lot of these people, their physical belongings were also burned up in the fires as well. And so an unfortunate situation, but that's kind of how the these people will be dealing with the ramifications if they do have a mortgage still on their property. And it's a really sad event. And I think there will be a rethinking of both insurance and fire prevention and readiness around the country for wildfires. And hopefully this doesn't happen to very many people in the future. So that's what happens if you have a home that burns down. You still have a mortgage. Let's try another question from our InvestTalk YouTube channel. Anthony Lombardo says, what are your thoughts on ticker APH, Amphenol Corporation? Okay, this is Anthony from New Jersey. Now let's take a look here. APH, this is in the semiconductor, electronic parts, space. They make electrical, electronic, and fiber optic connectors and in cables. And this is a company we've looked at for, it's on our watch list, I should say that. We haven't picked it up yet. A lot of it has to do with the multiples that it's trading at. Supposed to earn $22.17 this year on a $72 stock. That's a high 30s, mid 30s multiple. That is pretty expensive in our book. Now, from a technical perspective, let's take a look at the chart. And this has pulled back recently, but generally it's been chopping sideways since May of last year, kind of in the 70 range. Now we're at 72 and change at the close today. And one thing we really like about it is the profitability. Return on equity 25%. That's very solid profitability, and it's been consistent right around that 25% level for a decade plus. And so we love companies that have that consistency to their business. Free cash flow $2.3 billion, which is near an all-time high on a market cap of $87 billion. Not a huge free cash flow yield there. Only about 2.5%. And that's probably our biggest issue is that, enterprise value to EBIT is around 29, near an all-time high. And that's with, and the positive here is that earnings are expected to accelerate into this year. And so that's why the multiple remains high, but continues to be on our watch list. It's not cheap enough, but we do like the business and would be patient for a better price.
For comprehensive investment resources, visit us at investtalk.com.
Hi, this is Mark calling from Ohio. I have a question on Victory Capital, ticker VCTR. I have a small position in it and I'm looking to add to it. The company just sent out a press release not too long ago about a share buyback program. So I was going to add to my position. It's not a core position. It's more of like a satellite position within my portfolio. Just want to get your thoughts on the company from now through the next 10, 20-year holding. Thank you.
All right, looking at Victory Capital Holdings, and this is kind of a much bigger KPP Financial, and they franchise their operations, and so it's a $4 billion market cap here, return equity 24%, so it is very profitable. Not a whole lot of debt in the balance sheet, which I like, but overall, the profitability metrics are solid. I like that they're buying back shares. We love that when they have good cash flows and they are looking to buy back shares. Now, how much is it? Am I seeing that here? I purchased $200 million. So that's about a 5% of the overall value of the company because it's a $4.4 billion market cap. So, $200 million is nice, but it's not super dramatic. But I like that they are returning that cash flow to shareholders. Free cash flow is $343 million. So, overall, I have no problem with this. Good business, pays a nice little dividend. And I'm going to give Victory Capital Holdings a thumbs up. Thanks for the call. Now, lastly, let's touch a bit on debt issuance, corporate debt issuance, and corporate borrowing kicked off a big start to the year, $83 billion in bond sales in the first week. And this is the highest borrowing amount through January 8th, year to date, since 1990. Okay. And you're talking about companies like Toyota, Caterpillar, BNP Paribas, Societe Generale. This is a large French bank. And so there's a huge rush of debt issuance to start the year, mainly because you have spreads pretty tight, meaning the gap between US investment grade and treasury rates is at 83 basis points. That's not far above its lowest level since 1990, meaning you're not getting a ton of reward for taking on the risk of potential defaults within the corporate bond space. Now, that's generally good for risk assets. It means that money is flowing, liquidity is abundant, and risk assets are a good place to be. Okay. Now, January is typically a busy month for debt issuance, but because of the Trump administration and the uncertainty there's been more and more companies that are, say, going early before Trump got in office. Now, so for the full year 2025, there's supposed to be $850 billion of high-grade dollar debt set to mature throughout the year. That doesn't include high yield either, okay? And really, that's the big issue here, is that there's so much debt that needs to be refinanced. So this $83 billion is really a drop in the bucket, only about 10% of the total needs for this year. And next year, that need goes up to over $1 trillion. So this is what I talk about with the back half of the year becoming more challenging from a liquidity perspective, because what happens here is think if you own a corporate bond. We own corporate bonds for our clients. There's a lot that mature this year, next year. For our clients, we're not taking a lot of risk because odds of defaults are very low. The duration risk there is also very low because they're going to mature in 3, 6, 9, 12 months. And if the Fed raises rates again, that's fine, because when those mature, we'll be able to reinvest at a higher rate. And so there's not a whole lot of risk on balance sheets because a lot of companies, investment managers, et cetera, own this level, these bonds. But what happens when those companies refinance, now those 3, 6, 12-month maturities turn into 5, 7, 10-year maturities. And then suddenly there is duration risk on portfolios, more and more duration risk on portfolios. And what do balance sheets have to do? They have to adjust. They have to account for that. That's what professionals do. They don't get in 51% of their portfolio in Apple, like the caller earlier. Okay, they have to rebalance. And when they're taking more risk on the duration side, they're having to sell other types of riskier assets on the other side. And that is where you potentially could get sell-offs in risk assets. So I want to highlight that because this is probably the most under-talked about story of 2025 and going into next year is the amount of debt issuance that is going to be needed both on the corporate side as well as on the government level treasury refinancing. So I wanted to highlight that and give you a sense of what we're thinking for 2025. Well, that about does it. I'm Justin Klein. This completes another episode of InvestTalk. Appreciate you all tuning in, liking and subscribing to this channel over on InvestTalk. And you can check out our podcast episodes anytime at iTunes, Spotify, Google Play, and be sure to rate and review on iTunes as well. Remember, we can help you better understand your risk tolerance level and your financial plan by heading over to investtalk.com and clicking on the portfolio review button and scheduling a time with me via Zoom. Independent thinking should success. Good night.